All right, welcome to episode 13 of the Operators Podcast. We are covering a whole bunch of stuff today, everything from Prime Day to China to consumer sentiment. Hell, we're even going to go into how we all invest our own money and whether we'll even invest in e-commerce or consumer.
It all started with a rumor, a whisper about a private WhatsApp chat where 9-figure entrepreneurs swapped insights, information, and deals behind closed doors. And now, for the first time ever, these operators are pulling back the curtain on their clandestine world right here on this podcast. You're about to witness something truly remarkable. A glimpse into the minds and businesses of the world's most successful operators. So sit back, relax, and stay glued to your headphones. The chat is about to begin.
All right, we're episode 13 here, boys. We're back. Got a lot to cover today. And I think, why don't we just jump right in? Because Mike, I know that this one's near and dear to you. Do you want to chat Prime Day? And then we can move on to some other stuff.
Absolutely. So everybody who's watching this probably knows that Prime Day was, it sounds like across the board, just a blowout by pretty much anyone's standards. Heard everything from people who weren't really running deals. That was kind of where we were at, running 3 to 4x a normal day, all the way to, you heard stories of people running 20x, 25x when you layer in deals, which that's obviously just unbelievable, lift from a promotional day. And the topic that I thought the way we could frame this is, what does this tell us about the ecosystem and Amazon? Is this just an indication that Amazon's continuing to consolidate volume? Because there's some estimates out there that they're already over 50% of the e-commerce volume. Are they consolidating even more? What do you guys think?
Sean, why don't you let us know? Because you're the least Amazon heavy. Well, I guess I am too, but what's your thought, Sean?
Yeah, so we did a little over 10x a normal day on day one, and then day two was probably 8x a normal day or something. And I've heard, same thing as Mike. I mean, a lot of people have had 2x, 3x, 4x. So if you're in that camp, you're not alone. I've heard a lot of people have that. And then, there's a big cohort that had 10x normal days. And then, the very far end, I mean, we have a couple friends in chat who posted $3 million days, $5 million days, right? Like some massive numbers. So this is a reversing of a trend for Amazon. Amazon Q4 2022 and Amazon Q1 2023 was down year over year. So I think they pulled out all of the guns to make sure that they had a huge Prime Day to actually show year-over-year e-commerce growth, because I did a blog post about this yesterday, but Shopify's, their GMV is growing 15% year over year, but it's because they're adding new stores, right? And new stores bring their own customers, where the whole beauty of Amazon is that they have the customers, but they're not bringing any more customers. They're not getting any new people. So they have to win over more of the share of wallet there, right? It's why they go into things like, organic and food and all these different like growth initiatives they've had. So the TLDR, I guess, is, look, I think Amazon has more growth in it. I think it'll grow faster than, the economy. It'll beat GDP. But I think they knew they had to do something massive. So I think they made everyone push hard deals. I think they drove a lot of traffic. I saw a lot of TikTok ads running from Amazon just to Amazon's homepage. And it was a great event. We've already beaten all of last year's July on Prime Day, right? So like it destroyed last year's Prime Day. So that's what we're seeing. Jason, what are you seeing?
Yeah.
Well, we had our two best days, like our combined 2-day period, our two best days as a company ever, period, on those two Prime days. It was insane. It was the first Prime Day was our second biggest day ever, better than Cyber Monday last year, and a fair amount lower than Black Friday. And then second Prime Day was basically our fourth best day ever as a company. So you put those 2 days together as our combined best 2-day stretch
I didn't
ever.
have that good of results, It wasn't.
We had like we like 30x an average day.
Yeah,
That's
crazy.
bonkers,
I
man.
think
So why do you think that
yeah.
was, Jason? Why was it so powerful for your brand?
Look, I think we have our individual pieces are priced quite high on our site due to inventory constraints, and so we really don't we haven't really discounted any individual pieces all year long. And so that was really the first time we've done that. And I know there are a bunch of people that are they're just waiting for a deal on certain of our really sought after pieces. And I think we executed it well. We planned it for a while. We knew last year was a good one, and we wanted to make this one a good one. So I think my team is going to do a full write up on it. But in general, I think, with Prime Day and Amazon in general, I agree with the points. But I think just with this economy and the way people feel about things, the consumer is definitely spending, but I think people are just waiting for deals maybe more. And it was just and plus Prime Day is just more known, like you guys said on a previous episode. It's like Black Friday. I mean, it's that big now. I think it's getting bigger. We might have had a little dip last year because things were weird, and also the Amazon price point. Our AOV is lower on Amazon, considerably lower on Amazon, and I think so that's a price point where people are ready to go in and like they can actually buy a bunch of stuff as opposed to like having to go to Guilt and drop big money. And that's just my very biased opinion based on my life and what I see about Prime Day.
Mike, like what did you guys, so you guys didn't go deal heavy on Prime Day?
Yeah. So we basically have a big Amazon business. I don't know what the GMV annually is, but it's getting close to 9 figures just on that channel. And in addition, we have one listing that really we started at the very end of last year that I think has spent at least a little bit of time as the number one item in all of home. And as a result, we've been just really chasing that thing all year and trying to get that in stock. As you guys know, there's kind of layers of in stock with Amazon. There's, hey, I've got it available in my warehouse and I can actually fulfill orders. There's Amazon has some of it in its fulfillment system and they can fulfill orders, but it's not available for Prime or for next day delivery in a bunch of different places. And then there's like Amazon is really fully stocked across their entire fulfillment network, and they can get it to people anywhere in the United States very quickly. And that's obviously where we get optimal performance. We got to have a whole nother conversation about that, but we've done a lot of research trying to understand, hey, depending on how much Amazon has in its kind of bloodstream, how does that impact sales? How does that impact the algorithm and how they show things to people? But suffice to say, the more they have and the more readily available it is, the more you're going to sell. And we've been chasing that all year to the point that I think Amazon did a direct import order with us on top of all the stuff we were doing. There were situations where they were buying units for that listing. We would get a shipment in LA, and they would buy those units and they would sell those units before we had even sent it to Amazon's fulfillment centers. Because we've been in such short supply, we were just like, man, we're not going to go back there. We're just now getting healthy. If we run a deal, like we do believe it'll blow it out, but like it's just going to put us back in inventory hell. And so we really set this one out. Probably the most interesting, I think a couple of interesting things I took away from Prime Day. One was, Sean, you said this an episode or two ago, and it really stuck with me. Every once in a while, you say something that really is good. Just kidding. But this was really good. You talked about funnel clearers. And I think, Jason, you just touched on it. The reality is you really do just accumulate a ton of people in your funnel that want your product, but that they just kind of sit and wait, and sometimes it's economic constraints. Like they really don't have the money to buy a HexClad pan at full price, and they're waiting for their opportunity. And sometimes it's just disposition. It's like they just want to say they got a deal. But I do think having those moments when you can kind of flush those people out and help them to go ahead and convert are really huge. And obviously Prime Day does that in a really powerful way. The other thing that was interesting for us is we've just started to go direct with Amazon. So we're 1P vendor with Amazon. And I posted this in the chat, but we did something crazy like $300,000 or $400,000 in Canada over a 2-day period. So just Amazon Canada did a couple $100,000 a day, and that was a pretty eye-popping number of like, wow, like I did not realize that it was possible to do that much volume in that particular market. So those were some of our experiences. We really didn't have the dry powder to go after it this year. And we've also, I mentioned this before, we've learned that when you go after it, one of the guys in our chat, one of the chats that Sean and I are in, he posted this, they got a top deal. And when you get into like that very top layer of deals, the variance just goes through the roof. And I don't remember what their number was. Sean, maybe you do. They were 25x or 30x normal day or something, but they also blew up their supply chain in the process. And this is kind of the point that I've been making, that it's like, I don't know how much deals help you when you blow up your supply chain. It's helpful in as much as you're able to harvest that and clear the funnel without just, smoking yourself and being out of stock or whatever.
Yeah.
Yeah.
Oh, I was going to, about the guy that really crushed it. I was telling him like, yeah, man, it's not going to be that good. Maybe 5-6x a normal day. And he ended up being like 30x a normal day. So I'm like, hey man, I'll eat my hat on that one. Fantastic.
Top deal is powerful though. Like it really is. Like that's so much visibility, right? And if you're right product, right price, right offer, it totally is a power law. Like
even if you get, like on a non deal of the day. So like a good example for us is August is actually Amazon's worst month. They've told us. But for us, we're really represented in things like back to school. And so like we've run a deal of the day on those days before. And when you're a deal of the day, I think at this point they do like 8 deals of the day. It used to be 1, and then it just, they keep expanding it. But the difference between being the number 2 deal of the day and the number 1 deal of the day is massive for a simple reason. You guys know what it is?
Homepage.
That's right. You're the homepage on the app. On the app has a massive tile that the number 1 deal of the day gets. And then there's another little link where it's like, hey, show me all the deals of the day. But you literally, your distribution just blows out on the upside. But you have no idea who the other deals you're going up against are, and you have no idea which one Amazon's going to pick to be the top deal of the day. And this is the reason why forecasting is so hard, is that if you're the number 2 deal of the day, hey, maybe you move whatever, 30,000 units or 20,000 units. And if you're the number 1, maybe you move 100,000. Like, how do you plan for that, especially when it's algorithm driven, right? Yeah. And you just don't know. So anyway, there's challenges.
I mean, look, Amazon did one thing. They proved that they can create a holiday that sticks, like a shopping holiday. Like I looked at I told my team, I'm like, man, they are the new Hallmark. Like they just made up a Hallmark holiday, and called it Prime, without like the stupid shit that goes along with it.
Yeah,
it's like good on Amazon.
Yeah, I wanna talk about something Mike brought up. Canada being really strong. So we sell in Canada, Australia, and the UK, and some EU markets. We're not in all of them, but most of them, all with Amazon. So we have Amazon FBA and Live in all those markets, and every market had a 5 to 10x normal day, right? Typically, Prime days are very US heavy. We see no uptick in the UK or Australia or Canada. They switched the marketing this year. Maybe more people are just aware of Amazon, more people looking for a deal, but even in the UK, which is a very weak market for Amazon, crushed it. And Australia is their weakest market. Like that is an emerging market.
They don't do well in Australia at all.
Yeah.
No, that's our shittiest Amazon market on both brands. Is we don't even bother in that market. We like Canada, obviously. It's a good consumer here, right? Like it's not a huge market. It's basically the size of California in population. But it is a pretty, we have a decent middle class in this country. So right price point, you can do quite well here. So I'm not surprised to hear that, Mike. And I think also your brand is getting more popular in Canada. Like my staff talks about Simple Modern, and that's interesting to me because they didn't before, a year ago. So you definitely are your brand is hitting the market here. No question.
It's also, Matt, the way that Amazon runs their fulfillment network, they have a acronym for it, but they have something basically that's a North American fulfillment network. And so if you have inventory that's at an FBA warehouse in California, they can actually, send that to a Canadian customer. Now they've got fulfillment centers in Canada, and it's even better if you have inventory there. But I think you're right. I think Canada's easily the lowest hanging fruit that we've seen from Amazon International. We've banged our heads against Amazon Europe for a while. To your point, Sean, we just became like a direct 1P vendor in Europe, which has been really good because I think they put in their initial PO, I think was 150,000 units. So like they're serious about growing it and they're committed to it. But man, we could have a whole nother episode about the trials and travails of selling on Amazon International, because you really start to take for granted what a machine they run in the United States, and then you try and do it in other countries and you realize, what a disaster it is. And the fulfillment networks are like not even close to the level of sophistication that they've got in the US.
Yeah, I know. You want a taste for what it's like to sell internationally, try doing it on Amazon first and then watch the legal and the shit you got to start dealing with when you start you start bursting through sales limits per country. And then it's like, okay, well, now tax has to come in, and Amazon's super strict on it. So they'll force your ass to get compliant real fast.
Well, and then Brexit happened. It was like, you can send stuff and it can be at this fulfillment center for all of Europe. And it's like, oh no, now Brexit happened. Okay, now you got to jump through all these regulatory hoops and inventory's got to move around. It's just a reminder of how good we have it in America and how entrepreneur friendly it is as a market. But
so anyway, I want to go back, Jason, that you made a comment that I don't know that I fully agree with, is that the consumer is still spending. Like, do you believe that the consumer is healthy right now? Like that, like wallet is healthy, or not, Sean, not your wallets, but like in general, the wallet, or do you think that that's just category specific, brand specific? Like, what's your thought there?
Well, I made 3 points. One is that I felt like this shows that the consumer is not as dead, right? The consumer is in decent shape, maybe not great shape, right? No more stimulus, all those things, but the inflation numbers are actually interesting too, seeing where those are all going to go. But I said people are waiting for deals. The Amazon price point is right. It's never one thing. It's kind of all three of those. I think. I just don't think the consumer is in that bad of shape, and
I would agree with that. I don't think they're in terrible shape. Did you guys look at the inflation numbers last week and go like look at them category by category?
No, what'd you notice when you saw them, Matt?
I mean, appliance is down, like it's 11% down, negative. So like there are like it, and cars, I think, is another one where like there's real deflationary pressure in certain categories, right? So like, and I keep hearing it: hard goods, furniture,
those were pandemic bubbles. Those were
big purchase stuff is for sure hitting deal city.
Yeah.
Right. And it's going to be interesting to watch.
Yeah. I think, all the data points to a pretty strong consumer right now. And I brought up student loans. We'll see if that changes in September. But right now, consumer feels really good. And I think a big part of that is like those large purchases are being pushed off because of interest rates. Like car dealerships are dead. Like, even if housing prices are high, nobody's buying houses, right? So they can stay high forever, but that just leads to a lot of discretionary income, right? If you're not upgrading your car, if you're not upgrading your house, you're going to Taylor Swift tickets and they're $5,000. Like that's what you're doing instead. So I do think discretionary consumer spending in our categories feels really great. And even globally, people are saying, the EU is in a recession. We're just talking about Amazon EU. Dude, we don't even focus on Spain, Italy, France, Switzerland, any of those markets on Amazon. I just get a bonus 5 figures a day rolling in. We don't even think about. So I think globally consumer feels really good. So I don't know what the fucking future holds, but right now I'm like, things are pretty good and I like it.
Yeah. But again, I think it's category dependent, man. I do. Sean, maybe this is a good transition to your other topic around like, just overall e-com sentiment seems to be low, right? And like it does feel like social is a bit more bearish at the moment. Where's this starting for you? Number one, it's like, why did you post that question? And then what are your thoughts? And then I want to kind of go around and get Jason and Mike too.
Yeah. The last thing I'll say on Prime Day before we transition to negativity is if Amazon has the best shipping and it somehow gets the best prices, it's the only place people should shop, just like mathematically. When you have deals going and everything gets delivered in 2 days for free, it's like, oh yeah, no, it is the best option, right? So I do think, to Mike's original question, we could see Prime and Amazon, Prime Day gets bigger, Amazon gets bigger, they take up more of that market share because it is the best place to shop, right? And I think this year proved the power of that. But to transition into negativity, yeah,
or not.
On social, right? And I think I tend to be Mr. Negativity. I beat a drum that like things are hard, they're getting more difficult, or they're harder than you think they are. And I feel like the rest of the industry's caught up with that, and now I have to take the other side that things seem pretty good. But there's just a lot of people talking about how like this year's really difficult. They're missing forecasts. They're losing money, and those conversations just be very private, like one-to-one messages. People would reach out to me, be like, "Hey, I'm going bankrupt. Like, what should I do?" But now those conversations are happening in public forums or on Twitter or in Slack groups, and they're people are actually being like, hey, it's more difficult. And we use a lot of data and research to look at like our competitors' numbers and what they're doing. And all of them have fallen off a cliff. Like, I think a lot of people, there's a lot of fast growing companies who focused on revenue and not profit. And now like they're bankrupt, basically. Like their sales have gone down to zero because they can't pay suppliers. And it's, this negative cycle we've all seen. And I have a lot of sympathy for that, right? But I just wanted to hear from you guys, like, it feels like a tale of two cities. Like, I hear there's people in chat doing $4 million a day, and this is our profit will be up 100% year over year in July, and then I have people going bankrupt. So, Matt, Jason, Mike, where are you coming from?
Fulfill.io is on the operators pod now, and I believe a number of us in the chat have recently implemented Fulfill, and we've always had massive problems understanding our inventory at HexCloud. I don't know why. It's just always been an issue for us. We implemented NetSuite, wasn't good enough for us. We've been on spreadsheets, Google Sheets, etc. for a while, and we are 95% done implementing Fulfill. The inventory piece is totally done. We're working on linking it back into NetSuite right now. We're helping them actually develop new tools within it, so that's going to be better for the next implementation. But yeah, shout out to Fulfill for jumping in on the pod here.
I think I think it really is a tale of two cities. But I think that your comment on like, I think the space is still, there's two places to be right now that are healthy, that I think is like you can move, which is really big or really small. I think it's just like, this is a classic like messy middle scenario where like if your brand is newer and hasn't been around a long time, so it doesn't have like a big wake. So like there's not this big, like Sean and Jason and Mike, like you guys have some history in your brands now, and like Peel cases like this, like it's just going to run, right? Like it doesn't require a ton of effort to like keep the damn thing going, but it's been around for enough years and it's got enough of a base of a customer, like a customer base. And there's enough of a wake behind that brand that like we can kind of carry through. But I think there's a lot of brands that like got bigger than they should have during the pandemic, like a lot. That's a big chunk of people. And that's like when you hear missing forecast, I think you have to take it in that context. Just like when you see like Amazon was down in Q4 2022 or Q1 2023, I'm like, yeah, because look at what they were comping. So I think that like there's a lot of nuance to this subject. And I do believe that broadly it seems to be like pretty negative feelings from a lot of people. But I think that we're also like not publicly acknowledging the nuance, right? Like it's not apples to apples. You can't look at this year versus last or 2021. Like that's just, I mean, you can, Sean, right? But like that's the other city is like you're continuing to grow through it. But there's a lot of people that shouldn't have gotten as big as they did during the pandemic.
I really believe in the concept of the messy middle on this because, some people are still totally crushing it. And like, if you're doing $2 million a year, there's no reason you shouldn't do $5 million a year, right? Like,
Right.
And that feels like a massive win, right? But in the grand scheme of things, any of our businesses, $3 million, like, is a rounding error. You know what I mean? We're talking single percentage points of our business, right? So if you're very small, I think there's still a ton of room to grow. Just post TikToks or whatever, right? Like you can totally grow that business, and it can feel like you're totally winning. And then if you're super big, yeah, you have that wake, right? And, I've brought this up where it's like, I feel unsinkable. I have 8 figures in cash, 8 figures in inventory paid off. Like I can pay for the best teams, the best talent, the best tests, the best tools, whatever, right? And like, yeah, we're going to be fine regardless. But it's that middle where like you're doing 20 or 30 or $40 million a year, and you got there off Facebook ads, and like you're still struggling to pay taxes and pay inventory and pay team members. That's what I would think is suffering the most right now. But Mike and Jason, what are your thoughts? Is people just being sensitive?
I have takes. The first is that think about the different pieces that go into being successful financially. There's kind of marketing, acquisition, there's forecasting, planning, there's what kind of costs are you paying? Usually people are getting stuff from China or overseas. What are logistics timelines, and what are the costs associated with moving product around? And actually, there's a lot of tailwinds right now. I mean, this doesn't get talked about as much, but like, guys, it is the cost to move things is dramatically cheaper than it was a year ago. The RMB to USD exchange rate is dramatically different. Like for us, just those two things. There was some kind of crazy number that one of our planning team told me, that it was like the move from the exchange rate where it was a year ago to now, and it's hovering around 7.2. I mean, which is kind of like a, I don't know, 10 or 15 year high in terms of it's favorable if you're importing stuff. And he was like, the combination between the logistics and that might add 10 million in EBITDA for us this year. I mean, it's a dramatic kind of swing how much it matters. And so I'm like, well, all right, in some ways there's a lot of tailwind right now. And like we can say the consumer's healthy, the consumer's not healthy. The bottom line is American consumers are the healthiest of anybody in the world. It's a relative kind of question. And we're definitely doing a heck of a lot better than China and Europe and Africa. It's like, so I think that why is the sentiment negative? I have a couple takes. One is the tools keep getting better for e-commerce, which makes it easier and easier to enter, which means there's more competition and there's more people that are just less talented that are in the space. I mean, like the combination is true that as competition, as you get more people, as you say, hey, the barrier to entry is, you can do this. You can set up a TikTok ads in 5 minutes. You can be on Shopify with a theme up and running in 15 minutes. That more and more people have come into the industry, which is great, but it is more competitive than it's ever been. There were entire verticals that you could launch into 5, 6, 7 years ago that like nobody was there, right? Like you were the only one. Another thing, and this is kind of my sentiment as somebody who doesn't spend as much on marketing, is that really sentiment just tends to go with acquisition costs on Meta and Google. Like it just tracks almost perfectly. And so you can have all these tailwinds in other areas, but if people are having a tough time on acquisition, then they're going to be in a terrible mood, because most of these businesses are so dependent upon that number and their financials that if acquisition costs rises 20%, there's not room for it to still work or whatever. The final thing I'd say is that the ones that are, I think, more positive, the sentiment's more positive, is where they built businesses where they can be omni-channel. I think we've talked about this in previous episodes, but the true, pure D2C, I have a website, just a website, this is my business. It just feels like that's less and less of a good idea, partially because you should be on Amazon. I mean, we've talked about that. We are all for on Amazon. Matt, I don't think you were on Amazon until when? Was it last year?
We put Nomi on when we got in stock last. We were like, our first days on Amazon last year were on Prime Day.
Yeah. So you're at about a year anniversary of it. And it's been great for you, right?
Yeah, I'm a fan. Like it's probably 20% of our revenue. And like the crazy thing is that Lomi only ever sells at full price on Amazon. Like I don't run promos there. We just don't do anything on Amazon.
Yeah.
To Sean's point, there are people who just like to shop on Amazon. You're an idiot if you're not there, because like that's the only place they buy something is Amazon.
Absolutely.
Well, that's the best conversation too. Like I still see brands that are not on Amazon and I just don't get it. I mean, and even if you're one of those brands that thinks you just are so premium or so protective of your brand,
fuck off.
And
you're not.
One of my favorite brands I was actually checking because I wanted to buy some stuff just in general. It was like after Prime Day, and I was like, can't believe he's not on there. And I just don't get it. I mean, Aesop was selling soap on Amazon, right? So,
dude, and if you're a D2C brand, like Matt, 20% is the number. Like you just add 20% in top line revenue by being on Amazon. So it's like, it's like you can fight about brand or whatever, but it's like, hey, is it worth 20%? The answer is yes. So just go do it.
At least, I mean, listen, it can be way bigger than that. There's a different game on Amazon where you can learn to compete on generic key terms. And we got really good at that, right? We built our business first and foremost on that. There was a point where Amazon was probably 95% of our business. And we reversed it, where we built it on Amazon and then we built out, the other channels. So it's doable. But like you're saying, Sean, if you really believe in the brand that you've created, and I'm not saying this is true for everybody, but it's worth saying on the podcast because I think all four of us would give this advice and do give this advice to other digital entrepreneurs all the time. Unless you're in this very small set of use cases, you should be on Amazon. You're just missing demand, and somebody else is getting that. People are going to Amazon and searching for your product, and when they don't find it, they're a lot of the time they're just buying something else that they can get one day Prime. I ordered something yesterday, guys. I got it in 3 hours. I'm in Oklahoma. It blew my mind that it just showed up at my door in 3 hours. Why? It's not surprising that people want to shop from Amazon. It's amazing.
Yeah. Mike, you brought up China and you brought up the exchange rates. And I think that is worth a 30-minute conversation because it is the best time to be doing business as a foreigner in China, right? The past couple of years, it was really difficult to place POs and find space in lines, and you were overpaying, and importing was difficult. Like we all experienced that. Where your suppliers, they're like, "Hey, our staff has COVID," or like, "Oh, hey, there's other orders coming in." Like we that was the COVID story. Their manufacturing is down 11% year over year, right? And exports out of China are reaching 2019 levels, right? Like they've erased a lot of that growth from the pandemic. And with the currency exchange rate, they hope that it would bounce right back, that the rest of the world would start buying from them again, right? It's not happening. I mean, I'm sure your guys' suppliers, what's happening to us is they're like, can we lock down volume? They're like, can we give you price cuts, right? Like there's a plethora of factories all basically competing in the same niches, and they're willing to do whatever it takes to get those things locked in. So, what are you guys seeing? I'm going to China next week to go tour a bunch of factories and build relationships or whatever. But it feels like it's a bloodbath, and it feels like they have, deflationary pressure. We're dealing with inflation where things are costing more, where their raw goods are costing less and less and less. And that's very difficult when you have an emerging population out of poverty. So what do you guys see?
Well, and I want to make a point on that, Sean, especially if you have any exposure to wholesale, like you sell to the Walmarts or Targets of the world. They understand that, and they are starting to try and get back some of those price increases that people pushed across the goal line during 2020, 2021, 2022, because they recognize that, like, one thing to remember is that if you sell to a wholesaler of any kind of scale, they almost for sure have a sourcing team that is constantly doing channel checks in China, constantly getting quotes, and understands what things cost and is comparing that to whatever costs you provide them. And their job is really to push back whenever they see those costs going down, but your costs are staying the same or going up. So I think it's real that, like, to your point, Matt, part of the reason for the deflation in appliances is demand softening. And part of it is that you're seeing retailers push back and be like, no, you're not going to charge 2021 prices anymore for that, fridge or whatever. Yeah, you could get away with that when everything was back ordered and it was really expensive, to move things around, but not anymore. So it definitely impacts things. Whatever, as China goes, it's going to impact what you see on shelves. And the point to a lot of people, even if you don't sell in physical retail, is you are being comped to that, whether you think about it or not. Right. Like, and so if appliances are getting, Matt, to your point, if appliances are getting 11% cheaper in stores and Lomi staying the same, you got, like that's obviously impacting things, and you guys are still thriving with that. But people have to be aware. It's the same dynamic. I draw my beat about demand. Like, listen, you are part of a market. And so if you're not competitive price wise, you got to make sure that you're comping well to stuff, whether it's physical retail or whatever.
Okay, here's
Jason,
my take
what's
on
your thought?
appliances. Here's my take on appliances and this inflation situation. This is just the pandemic bubble still popping in this sector.
Yep.
Because the demand stayed high longer because there just wasn't enough supply. It took a lot longer for the supply to catch up, and a lot of the demand. So the demand was pulled forward, but it wasn't satisfied as timely as the demand was in a lot of these other areas. I bought new high-end appliances for my apartment like a few months ago, and for Wolf and Sub-Zero, I was being told 18 months still. And like Miele and Gaggenau were like 6 months. I got lucky because I wanted like the basic model, and this one guy had it, and I got it in like a week. But it's just the demand was not satisfied in time, and now it has been. Everyone's like they've done the work in their houses, and now we're back to normal.
Yeah, Mike, I think you're hitting on a really interesting point with China. And Sean, I'm curious to see what you see when you're there, man, because we're hearing it from a lot of our suppliers, but we're hearing this from a lot of our suppliers. Mike, the retail thing is the important part. So like we're talking a lot about D2C on this pod, right? Because we all tend to skew either D2C or Amazon. We're nothing compared to retail sales. Like we're fucking nothing, right? 85% of transactions are still happening at the store. Companies like Walmart and Target, they actually do move the market. Yeah, Amazon's big, but like in store is massive, right? And when you go to China, Sean, like what my team is saying on the ground, these factories are not at full capacity, not even close. And the reason for that is that retailers, the biggest buyers, right? Like, no offense to all of us, we're fucking nothing. Like we don't buy what Walmart does or Target or any of them. So like the biggest buyers in consumer are still sitting on huge amounts of inventory from the pandemic in a lot of categories that they don't want to be. And that keeps factories not busy.
Even if they're not sitting on huge pieces of inventory, and this is just a point that everybody has to realize, it's been said that retail is like a ditch to ditch kind of industry. And so what that means is that they tend to overcompensate one way until they run into a ditch. And then it's like, oh, we don't like this ditch. And then they overcompensate the other way until they run into a ditch. And then
sounds like private equity investors. Sounds like private investors, how they look at sectors.
Good term.
So one thing to remember is there's we can do a whole thing on this, that like when you work at big public company X, right, and you have a good job, your primary focus is, hey, how do I not get fired? And if you are at a big retailer and you've been there over the last 2 or 3 years, the number one thing you're thinking about is, I am not going to get caught with my pants down and being heavy on inventory or being overextended on inventory. I have been in that ditch, especially if you're a CEO, CFO, like, top leadership in one of these things. And so now they're going to go to the other ditch. They're going to try and run too lean for a while in most places. And that exacerbates this thing in China, is like, hey, all these factories are competing, it's a race to the bottom. I'm going to try and keep my turns really tight, and I'm going to try and play all these factories against each other. And all of this leads to I think the larger thing, and Sean, like, we'll be curious to hear your experience when you come back, which is that the reports we're getting is that China's economy is not doing great. And that potentially, it's always a little bit opaque what's going on there compared to, what's the reality on the ground and what do the numbers say, because you don't know how much you can trust the numbers. But China's economy is really based on exporting. It's really based on manufacturing, and the demand for manufacturing is at best, tepid right now. And so as a result, there are some real opportunities for the people listening to this podcast to take advantage for their business. And but it all goes back to, like Jason's saying, we're still in, I think, the ripple out of the craziness from 2020 and 2021.
So, Mike, in 1995, I believe China imported 2% of their food, right? And as China became an exporting powerhouse through manufacturing through 2008 to 2018 till now, they've imported 32% of their food, right? So it's over 10x, 15x their food imports, right? As their population has grown that entire time. They were exporting things to get dollars to import food, right? And it is a very challenging situation where you are reliant on food imports and then your exports fall off a cliff, right? As China has moved their manufacturing class from poverty to middle class, right? They have to pay that talent more. That talent is being now cut, undercut by people in Vietnam, people in Mexico who are taking those jobs. The same thing happened from Japan was a manufacturing powerhouse. It went to Korea, was a manufacturing powerhouse. From Korea, it's gone to China, right? That is the second half of the 1900s. It's happening now where those manufacturing jobs are leaving China, not in mass. They're still the manufacturing capital of the world, but they're going to Vietnam, they're going to Mexico. And it's a very challenging situation when you need export dollars to import food, and I think it puts China in a very difficult spot the next 10 years. So I'll let you know what I see when I'm there, but that's just that's a crash course in history playing out in front of us. Dan from Northbeam is one of the smartest people ever. If you want to talk about someone who is early to AI, early to fucking marketing tools or whatever else, I have no idea what his background is. I was going to say he was a researcher at Harvard, but I might be making that up. I don't know. Dan's the CTO, technical co-founder of Northbeam, but really is way too smart to be working in e-commerce. The guy should be teaching cars how to drive, but he's instead trying to figure out how to make my clicks better or whatever. So shout out him, another class act.
He's giving us all the warm and fuzzies on every dollar that we spend. So thank you, Northbeam, for doing that.
We started talking about sentiment. We ended on China on this segment. But one final thing I'll say that I saw on Twitter that was great last night. An economist did a real deep dive on, hey, are the tariffs impacting China? And they looked at a lot of different things. They looked at the United States and Europe, because Europe's kind of a control. They don't have the tariffs. And more or less what they found is that there seemed to be a period where China was pretty resilient to the tariffs as you were getting into 21 and maybe even early 22. But it is now really clear the tariffs are hurting China. And it's actually really interesting. Europe has not put any tariffs in place. And Europe, their share of imports that China is making up has just continued to skyrocket, whereas the U.S. has kind of turned over some, and you've started to see a real disconnect between those two regions as a result of tariffs. And so, listen, it matters. Like on some textiles, it's like 30-something% between tariffs and duties. Like that matters. And that's going to make people go to Vietnam and stuff like that,
Dude, and even if it doesn't actually matter to the bottom line, it's like, okay, a small increase on raw goods. It scares factories in China that are like, oh, maybe we will not be able to do business. We have to get ahead of this. And we're getting pitched by factories that are like, hey, we're like, Chinese companies are like, no, we're in Vietnam now. And we're in Mexico now, right? Like we can get you tariff-free goods. They're making that investment early, right? And that's difficult for Chinese companies to do, but they're totally doing it, right? And they're like, yeah, now we've stood up factories in other places. Those are dollars that are going to totally miss out on mainland China. So It is.
We're seeing it in small appliance. Small appliance is not cut and sew. It's not easy, right? There's a lot of shit that goes into these things. And you're seeing like Chinese factories are setting up shop in like Bangladesh and Vietnam. And
Mm-hmm.
like they're like those companies are getting ahead of something. Right.
To me,
So
that's
like,
one of the most interesting things is what happens if a factory has Chinese ownership, but is in Mexico or Bangladesh or Vietnam, and then there's some kind of political conflict between the U.S. and China. What would happen there? Is that really a risk mitigation factor or not? Or is it one of those situations where in a world like that, the U.S. is still going to say, no, you're freaking owned by somebody in China. We don't care where you geographically are. You're going to be treated like a Chinese factory. Because that's certainly what you're seeing, Matt, is you're seeing these factories try and geographically diversify themselves. But I'm not so sure that that would be effective in the kind of scenario that people are thinking about.
it's not a short-term thing.
Right. We would have
like no question.
We would have to look at the closest thing I could think about would be did we buy Iraqi oil from like different subsidiaries? Like because I mean the enemy states of America, Iran, North Korea, like they don't have any producing assets outside their borders. The only other enemy we had would be Iraq, and you know we still bought Afghani opium. I'm pretty sure. So we could do some research on that.
We start with how are people feeling on Twitter about D2C, and we end with Afghani opium. We have certainly hit the spectrum.
Covered the gamut. All right. So I guess, is there anything else you guys want to say on sentiment before we move on from China and sentiment?
I'm just glad we have the gang back together. These episodes are always so good. They just flow so naturally. Mike, you had something to say?
The core
I'll say
four,
one more thing.
The core four are here.
Let's go. Yeah. The core four. I love that. So one of the I follow several real estate people on Twitter. Twitter has a really robust real estate community, and I'll just share one more anecdotal thing that's super interesting. One of them did a big thread where they were talking about one of the more frustrating things right now in major metropolitan markets is that they're losing deals to buyers that are buying at prices that don't make any sense. And they were kind of breaking down, here's what's happening. The buyers, it's Chinese money, where the buyers are saying, we think the exchange rate between the RMB and the US dollar is not reflective of reality. We think inevitably this thing is going way higher, which would be good for importers. And so we're just not price sensitive. We're buying on like a 30 or 50 year time horizon, and we've got to get this money invested in someplace other than China. And so we don't care if we're buying at a 3 cap or a 4 cap, which is interesting. There's at least a contingent that exists of people with a lot of money. Whether or not we think that they're right or wrong, who knows? I guess time will tell. But that really believe that exchange rate's going to blow out on the upside, that it shouldn't be 7.2, but it should be 8.2 or some kind of crazy number, 9, I don't know. And that they are making real estate buying decisions around that. I'll just say this. I don't know what would happen if the exchange rate went to 8, other than it would be incredibly disruptive, probably in a way that's great for American consumers. But that's another thing to keep our eye on, is like that exchange rate really matters because it really moves around the real cost of things and the balance of power between countries. And it may be going higher. We'll see.
Yeah. I mean, there's a lot to unpack there in the way that the Chinese government lets people invest, right? Like, it doesn't surprise me that a rich Chinese, consumer or expat trying to leave China would be very interested in real estate, because per capita they own more real estate than anybody else, because the average home sold in China is somebody's 1.7 home. Like, they're not allowed to invest in foreign assets, so they can't own foreign stocks and they can't own crypto. So they can only put money in the Chinese stock market, and they're limited to how much they're allowed to put in. I think it's, $50 a day or something. It's very, very small. So that has propped up this Chinese real estate bubble, right? Where people are buying, the average home sold is their second home. That's not that's not a sustainable system, right? When their population isn't growing. And they've worked very hard to try to get dollars out, right? And if you've ever done business in China, you know that people are like, hey, will you pay my Hong Kong entity for this stuff, and we'll show it laws
Right.
in this thing. They really want to get dollars out. And I mean, that drove up Vancouver real estate prices. It drives up New York real estate prices.
I was going to say Vancouver is a massive benefactor. Well, not even a benefactor at this point. It's gotten so unhealthy because of that effect, Mike. Like it's long. I mean, it was happening a while ago.
Go to Beverly Hills.
Right. But if you ask anybody,
there are $50 million houses that are just basically purchased by Chinese people who want to use that as a bank. That's what they do. That's where they just put their money. It's the same.
We actually have a foreign. Yeah, we have a foreign. What do we call it here? We have a property tax, that if you don't live in the home you own, you get taxed here. So like empty homes get extra property taxes in all of our major markets in British Columbia. For that reason.
Yeah. And it's not a uniquely Chinese thing, right? It's something like 30% of commercial real estate in New York City is owned by Russian oligarchs, right? Like, because it's a very safe market to park money. Like they don't even want tenants in it. They just want, it's essentially a banknote, right?
It's protection. Like they're protecting their assets by parking it in real estate, real assets, right? It's like, take your cash, put it into a market that's like stable and growing. It's old playbook.
Yeah. And
right. They've been doing it a long time.
I always say that there's rich people everywhere. Like the top 1% of China, they got 1 billion people. That's a fuck ton of 1%. And people really hate being rich and then not being rich. That's probably the most painful thing is losing wealth, right? So they'll do a lot of stuff to save it.
Let's do a quick Panzerism. All right, we're going to knock this one out fast, get out of the way. So the one for today, time kills all deals. Here's why I want to talk about time killing all deals. Sean brought this 100%. Up. Sean brought this up on the audit stuff, and how they had this difficulty with an audit and things dragged on. I'm not involved at all in what happened in that place, but it just reminded me of this. As a banker, I've seen this so many times, and I know that there are a lot of people who listen to the pod who are interested in doing deals, whether they're raising money, doing an M&A deal, but just in general, this works in just about anything in the business context. Time kills all deals. You just deals have momentum. Any deal has momentum. I'm just constantly reminded of this, where you can sit around and overanalyze things, and then the opportunity is just gone. You wake up one day and the opportunity is gone, and people are just busy, right? You're busy. Like if you don't respond to an email or a Slack right away, it might get buried. We see that all the time. And I just see too many people like overthinking stuff and dragging things out. And particularly when it comes to a deal, you've got to keep the momentum. You have to keep things moving. You have to be smart about it, right? You can't be just push without any analysis, but you have to crack the whip. You have to get everything moving, because otherwise time is going to kill your deal. And I just think when people are thinking about raising money or selling their business, that's like, after take the fucking money, which we did already, it's time kills all deals. Just like, you need to keep people moving. You need to execute on all fronts. Otherwise, people get distracted, deals lose momentum. Deals are all about momentum. And I wanted people to remember that.
It's like to kind of take a meta, like it's a great Panzerism. It's funny because it's really just an expression of something that everybody who listens to this already knows. Like the Google research says on mobile, for every second slower that your site moves, conversion drops 27%, right? And we all know that, right? Like site speed matters and conversion, but it's just a microcosm of what you're saying at a macro level, Jason, which is the longer that people have to think about anything that they think they want to do, the more likely they are to just not do it. And whether that's completing a deal or converting on your website or saying yes to a job offer or whatever else, like time works against you. And so it's kind of a cool like principle. I'm going to take this away and think about it. Like, how do I reduce kind of lag, or how do I kind of do the equivalent of increasing my site speed in all these different vectors of my life that I wouldn't normally think about that, because that time is just a drag and a conversion killer.
Yeah, new is exciting, right? And so the first time you hear about something, you could be very excited. But when something takes 2 months, 3 months, 6 months, you've heard about it, you've been in meetings about it, pretty soon it feels like a chore. You're like, I don't even fucking want to do it anymore. And I've found myself doing that when I've been acquiring companies or partnerships with people or whatever. I'm like, I'm bored. I don't want to do it anymore, right? Because new is exciting. And
yeah, there you go, Sean. You're you look at deals, right? And you've done at least one at Ridge. And so if people aren't providing you the data, right? Like that's the perfect one where when you're in diligence and the investor or the buyer wants this information, that's why you need to plan ahead. That's why you need to have your financials clean, because you just lose that momentum. I'm sure you've been distracted away from a deal, right? Like you just didn't have the time for it because something else got in the way, and you might have been more interested had the momentum kept up.
So we've bought in one company, we've made investments in 2 companies. I'm buying 30% of a company right now, and I'm buying a building right now, and that's going great. Like the guy knows exactly what he wants to do. It's quick, it's easy. Like we're just jumping right into it. But we've been in situations where someone approaches you with a deal, but then like they don't really know what they want to do, and it's like you're giving me a chore. It's like you want me to you want to do something.
It's in the too hard bucket.
You want to like work it out with me, and like that's the easiest way to lose my interest, right? Like have a clear cut ask so that like we don't have to waste time, because time's so valuable.
It is a good lesson in patience and impatience. You should be very impatient every day, and you should be very patient over a longer period of time.
That's wisdom right there.
So
I like that one, Matt.
That's a good
Matt,
one.
Unpack that, Matt, because it sounds good, but my brain is still trying to process it. Like, what does that mean? Like, how? Explain how you apply that.
So, Mike, it actually works with what you were saying. So, like, I'm a really impatient guy, like in the moment, in the day. Like when I want to do something right now, I want to do it right now. Mm-hmm. Right? Like if we've got short-term projects, like, Jason, we're going through a process. It's like, it's a short period of time. And in that short period of time, I'm highly impatient. Now, when I zoom out and it's like, here are the objectives for the business, the mission, the vision, all that stuff, you have to learn to be patient, right? Like building big things does take time. Mm-hmm. So it's more of a like daily action versus long-term strategy. And as a CEO or as a leader, entrepreneur, like you need to learn how to zoom in and zoom out and know the difference. Like you need to be able to identify, like, this is something that I really should be impatient on. Like I should be pushing the shit out of it. Yeah. Or this is probably going to take some time. Take a step back, take a breather. Like this is a multi-year investment.
I am horrible at being patient in the long run. There's a bunch of shit I want to do.
We all are.
Yeah. There's a bunch of shit.
That's why I bring it up. We all are.
Yeah. If I could just find that peace and that zen to actually sit there with like things that take 2 years.
You're still a baby, Sean. With us, this is actually something that I love the way you said that, Matt, because this is something that really helped us last year and this year. There are so many things that we want to do, so many things that I want to push on, and it's just we're no longer a dinghy. We're not even like a cigarette boat. We're like a battleship, and I got to know that there's things that are going to take 6 months, right? Some things are going to take longer, but the bigger initiatives that I have are like year-long initiatives, and I try to get them knocked out in 6 months.
SendLane, right? And like, we have to give Jimmy a shout out. You know what? Like, can we just talk about class act of a founder and a CEO that is? Because like, I think we actually had a pod where we were talking about SendLane and how hard it would be for them to compete with Klaviyo. And dude was on Twitter, like subtweeting us and responding to us saying, challenge accepted. Right. And then now we're starting to see it in our chats about the conversations that SendLane is having with e-com brands and how they're showing up to these conversations and giving Klaviyo a real freaking challenger in this market, which, let's be honest, right? As operators, this is the thing that we need. Like, we need competition in all of the tool sets. Otherwise, these SaaS companies without competition, right, they run away on pricing and they start doing Yotpo dumb shit, right? Where like the pricing gets so obscene.
Right. And here's the thing about Klaviyo. They're acting like a big company, and like they don't give me support or tweet me or talk to me or whatever. Do they fucking forget that they're laser focused on e-commerce? It's like, and then you have Sendline coming in and just being like, we'll have one-to-one relationships with the 500 e-commerce brands that we need to sign to be a $1 billion business. And Jimmy's doing that, right? He will personally call anybody who wants to talk to him about it. And it's like, oh, Klaviyo acting too big to fucking do that. I mean, Harley will do that. And Shopify is a lot bigger of a business, right? So,
yes,
all I'm saying is, if you're going to hyper focus on an industry as small and as insular as e-commerce, be a human about it. And that's what Sendline's doing. So,
it really is, man. I've in the last few months, I've just found so much respect for what they're doing. It's kind of cool that they're a sponsor of the pod.
Yep. It's funny because like I've learned with me, it's exactly like you, Sean. Like when I'm really fixated on something, it's like urgency, bias to action. It's really difficult for me to truly be patient. And so the way that I manage it is, and this is one of the reasons why I enjoy running a company at our scale, is now I might have 20 or 30 of those things. And so I'm able to kind of rotate my focus. So I'm like, okay, I'm focused on this thing. Hey, what are the next steps? Let's move with urgency. And it might still be 3 months until it's coming out. But then I can be like, okay, now I'm not going to think about you for like, 8 weeks or whatever. And I'm going to work on this other thing. And I kind of like work my way around the business from A to B to C to D to E. And by the time I get to F, oh, there's something interesting that happened on A. But man, if all we were doing was A, those people would just be sick in the casket about it. Because every day I'd be like, where are we at on this? Where are we at on this? And so I'm actually able, like, I'm able to make myself, I think, more enjoyable as a leader by just having more things I can focus on, because of exactly what you're saying, Matt. It's like when I'm focused on something, there's such a bias and I have to watch this too. We all do. Like when you're in kind of executive leadership, like it's really easy to get excited about something and be like, we got to do this. We got to go after this. And not necessarily, for me, think about all the other things I might be blowing up to make them go after that really hard right now. So anyway, it's a good thought. I like the way that you guys think about it.
Mm-hmm. We're an hour and 12 minutes, hour in. Do we want to jump to investment? We can probably hit this one. We might actually want to do a bigger episode on this. But I would like to, Jason, you brought it up, and I know, Sean, you've got thoughts. I'd love to hear Mike's, but Jason, why don't you say like, what's on your mind?
All right.
Like,
I'm going to tell you what's on my mind.
You introduced the topic.
I'm so ready for this one. You guys should not be investing in e-commerce businesses. You should not. You should not be investing in SaaS businesses or other businesses whose primary customer is e-commerce. Okay. Do you guys know what a CFA is? Have you seen that? Like a lot of the Wall Street analysts have that. It's like a 3-year process, chartered financial analyst. A lot of portfolio managers do it. You have to take the exams over 3 years. It's all about portfolio theory and portfolio management. I did that. So you can add JD, MBA, CFA. I don't know why I was so dumb. I loved studying so much when I was younger. But you guys, particularly Sean and Mike, have so much of their net worth, so much of their risk is in this space already. It is not prudent until you are done, until Ridge is exited, Simple Modern is exited. You guys are absolutely overconfident and biased in the way you are investing your money, and you should take 10% of your portfolio to go gamble with. Okay. It's like all the people that invested in First Republic Bank and the other ones. This is gambling, right? And I see in the chat and I see in other places. And dude, I'm totally victim of this too. Like I suffer from this disease as well. I see great e-com companies and I want to invest in them. But the one caveat that I will give to all this is that if you have your own, like hedge funds outperform the market only when they have a proprietary advantage, an informational edge. And I will, granted, I will say that you may have an informational edge because you know the space so well and you know the players so well. But still, from an overall portfolio theory, portfolio diversification, none of you should be investing in e-com stocks or SaaS businesses that serve e-com stocks, period.
Oh man, I have takes. Okay. So 2 takes. I'll tell you guys a story. During the pandemic, because like the things crashed during the pandemic, right? And it was like there was a fairly clear buying opportunity. And I've got a background investing in stocks, and I'm like, man, I really want to invest in this stuff. But I realized exactly what you're saying. The first thing I realized is, okay, I have a lot of portfolio risk because I don't know what the heck is going to happen with Simple Modern. Like, I don't like, this is during the early part of COVID where it was like, we didn't have any idea where it was going to go. And so here was my strategy. I shorted Yeti, and I'll tell you why I shorted Yeti. It didn't have to do with me knowing whether or not Yeti was going to go up or down, but I thought if I short Yeti, then I'm balancing my risk. It's the closest thing I can do to hedge on my risk of drinkware having a really rough stretch.
There's a name for that trade. I've got to go look it up. That's like a pair trade.
Yeah,
that's some kind of pair trade you just did.
It's a pair trade. It was just a pair trade. It was a pair trade on the industry, and I ended up actually getting my ass kicked on that position. But it didn't matter because I would, the industry did well, and it worked out. But the other thought I had, and I think, Jason, this is what you just said. There's so much wisdom, and I just want to share this with everybody listening because it was a breakthrough for me. If you own a business, so much of your net worth is tied up in that business that it is very difficult to meaningfully impact your net worth or your financials by investing in anything, really, right? Like for me to meaningfully move my number, I've got to either have so much money liquid, which I don't, or I've got to hit such a massive home run that number one, I probably can't move my number. But number two, here's the thing about investing in things. It distracts you. It takes up your time, right? Like you're thinking about, oh, if you're in the public markets, you're watching the ticker and should I sell today? And it's eating up mind share. And what I realized was me investing in anything that ate up even 2, 3, 4% of my mind share, it's almost impossible for that to be a good investment financially or mentally for me. And so like actually what I should be doing is I should just be indexing or something and taking the intellectual complexity to zero on outside investments because it's not going to move the needle. Any amount of outperformance I can generate is not going to move the needle compared to what I can do in the business. It's just a distraction. And it's preventing me from focusing where I really have leverage, where the right decision, I can create tens of millions of dollars in value. And I can't do that in the public markets or in any investment, really. So I think it's a great point, Jason.
I want to hear from Sean.
What's your all that comes up for me, Mike, when I'm listening to you talk is the more you own, the more you grown. So, Sean, what's your take?
Oh no, for basically ever, I've said exactly what Jason said. Right? It's like you're overexposed to e-commerce, right? Like I don't own very much Shopify at all because, if Shopify does well, Ridge should be doing great too. The two pushbacks I've received, and the first one is I own a ton of Meta, right? Like because I feel like we have an unfair advantage there because I know how much money I'm giving Meta year over year, and I am a small signal, right? But I'm still a signal. So I do own a ton of Meta stock. The second is your deal flow is based on your expertise, right? Like I get pitched ecom brands, I get pitched SaaS companies, whatever, and I'll only invest in them if there's an unfair advantage. Mostly being like, hey, do I get it for free, right? Like, I'm my CMO Connor he probably owns like a 0.5% of Northbeam, and he's given me some of his shares for free. So I'm an investor in Northbeam just by proxy. It hasn't cost me anything, right? So I, as a rule, will not invest in ecom brands, will not invest in, SaaS startups or whatever, because I'm so overexposed. Very fringe cases where I break that rule.
There are a lot of people who do not follow that rule, Sean. And as I go to conferences and and there are a lot of people that they work in the space and they invest in a bunch of businesses in the space. But this just reminded me of, look, there's, even with your competitive advantage or unfair advantage because due to your knowledge of a certain business or space, like Meta, for example, you're not accounting for systemic risk. That's non-systemic risk. You got your specific understanding of that, and the way people should be investing is to take an overall portfolio approach, determine how much they want in an asset class, and in equities, like Mike said, just buy the index, because otherwise we're all suffering from cognitive biases in everything that we do. And it's just like, if you're buying individual stocks, you just think you're smarter than you are.
Yeah. And iOS 14 happened. If you had an e-commerce brand and you owned a ton of Meta stock, you just double loss, right? Like you got punched in the face twice.
Right.
You're too many chips on that side of the table. But I do want to talk about what Mike said. If you're a business owner, in culture, there's too much communication around investing and, you have to be diversified or whatever else, right? Like every piece of content on TikTok or Twitter or LinkedIn is all about like this one concept. And as a business owner, it's silly because my liquid net worth outside of rich stock is 1% of what the rich stock is worth. You know what I mean? Maybe 2%. And do you want to spend 40% of your time focused on that 2%? Like exactly what you said. Like I would need it to go parabolic for it to be worth. I made one decision yesterday inside of Ridge that will do $30 million in revenue, right? I'm very confident in 12 months we'll have an extra $30 million in revenue off of one decision yesterday. For me to do $30 million off of one decision in stocks, I got to be the luckiest stock picker on earth. Like it is, like you should just put all of your money in the index fund, all of your liquid net worth. Or right now, I own a fuck ton of treasuries, right? You just put all your money in something that's very low risk, move it once a year across buckets, and then just focus on increasing your stock price.
Yeah, I have nothing to add. I agree with everything that you're saying, Sean.
I'll make one addition. Oh, sorry, Matt. Go ahead.
No, go ahead, Mike.
No. I was just going to say the two exceptions I think to this are, there are times where, and Jason, you nailed it. It's kind of like, if you don't know who the sucker at the table is, you're the sucker. It's like, if you don't know what the particular advantage you have in a transaction is, then you shouldn't be doing it. But I do think, not just informationally, but sometimes there's relational opportunities that come up. Most of the, like I did an investment recently, but the reason was because of the relational piece. Number one, I really know the people that are running it, and number two, I'm getting a better deal because of the relational connection. I'm getting some kind of a discount because of the relational connection, and what I can bring to the table in just terms of helping them. And so like those are great opportunities. And sometimes those opportunities are worth taking, where it's like, hey, just because there is an arbitrage of like what you can get as a result of who you are, relationships that you have. The other one where I think it can make sense is sometimes there are things that I kind of want to watch that I think could be interesting for Simple Modern, but it's not time to put Simple Modern money in. So I might put a little bit of my money in as a kind of a placeholder, so that I can kind of watch that thing and track if I want to buy it with the big asset, which is Simple Modern.
Yeah, I was going to say, the only thing I would add is the only angel investments I've ever done are when I know the founder.
Mm-hmm.
Like, so I'll bet on the person, right? And I don't. So Jason, I have never done an angel investment in ecom. I just I don't want to.
You're like me. You invested in an incredible house.
It's an exposure thing. Home. I'm like Sean. I own you call them treasuries. Here we have, I think they're just called high interest savings accounts. Like I just buy things that are like not market exposed and then have like a guaranteed return with cash. It's like where I leave my cash. But from a do I invest, do angel investing? Yeah, I have ed tech and a bunch of other stuff, but I just know the founders and I know that they're gonna they will run through walls to build those companies. It's teeny tiny amounts of my net worth, but that's the only way I do it. I don't like to invest where I'm building.
Yeah. Well, and you said, Matt, you're doing it for you. You're not doing it for financial reasons primarily, right? You're doing it at that point
these are
for you,
man. This is every angel investment I've ever made is I'm willing to lose this money. I'm a big boy. I know this. I know the odds on this are going to suck, but if they work, they work.
Right. Okay. So people always say this, and I don't think people take it seriously enough, right? Because you have so many young kids who are 20 or 25 who or even adults who have just been fascinated with Silicon Valley and angel investing for the past 10 years, 15 years, whatever. No. You literally don't do it unless you're rich. I talk to people and it's so frustrating. They're like, well, I angel invest. That's my diversification. I'm like, no, you are betting on the dead horse every time. Until proven otherwise, that horse is dead. Right. And so Matt, you're in a place where you're like, look, I can lose $100,000. I don't care about losing $100,000. And I think people want to pretend they're that person, right? But you're not until you are, right?
Yeah, you're not until if you can go out and lose. This is the thing with angel investing. I really don't think people should do it unless your house is paid for. Your life needs to be paid for before you still go fuck around with literally the highest risk asset out there. I think it is. Dude. And you have no business doing it. My only criteria is literally do I know the founder and do I believe that this person is going to build something? That's it. I don't know shit. I've got an angel investment in edtech. It's SaaS in edtech. Okay. I don't know shit about edtech, but I know the guy. And he's super passionate about it. He's been beating his ass up to get he'll run through walls to build that company. So yeah, do I take a flyer on that? For sure. Am I going to invest any amount of effort and energy into understanding ed tech? Fuck no.
Yeah.
1%, right? To Mike's point, 1% of my capacity not in my core businesses is a useless, it's just useless. Don't do that.
Right. And then, going with the individual stock picking, it's there's people whose full-time job it is to understand individual stocks.
Yeah, you're not smart enough.
Yeah. And
that's the point. Okay, everybody.
It is the ultimate cognitive bias.
It's all cognitive bias. It's
overconfidence. I'm going to use 1%.
It's all overconfidence. We are all overconfident.
To think that I'm going to use 1% of my mind share and I'm going to outperform somebody who this is all they do. Yeah. Man, that is
those guys don't even know what they're doing. Those guys don't even know what they're doing. Okay, those guys are all gambling too.
That's the best part.
Yeah, I mean.
Gotcha.
Okay, go ahead.
No, gotcha.
I was gonna say, it's I call it ignorance, right? Because you're gonna buy stocks that you've heard of, right? Which is Apple, right? You're gonna buy Meta. You're gonna try to make trades of Shopify or whatever, and it's okay, today there's publicly traded companies doing earnings. There's 12 of them. Okay, do any of you guys know Amcon Distributing Company? They're doing earnings today, right? Are you guys going to make that trade? And it's what I'm trying to say is the market is so fucking big. It's not just 5 names that you've heard of, right? You guys going to trade off a Domino's stock? It's no, you're not, right? You're going to do the same fucking trades everyone else in e-commerce is going to do. And so it's just don't pick individual stocks. You're going to lose.
I want to do a quick tirade on the finance history for a minute, coming from investment banking. Okay. It's incredible to me. So back when I first got into banking, I was an M&A lawyer and I was an operator, and I got into banking in 2008. And when we would be trying to sell a business, we would be thinking about, who are the likely strategics, right? And we spent most of our time thinking about who were the likely strategics. And a few years into it, things started changing, and private equity firms were doing all the deals. And the pendulum has swung so far. And it's just this financialization of the U.S. market. It's absolutely incredible to me. You saw it with like the with the mortgage blowout in like 2008, right? Like the market, the economy has been so built on financial instruments, financial institutions. The rise in tech has kind of alleviated that or ameliorated that to some extent, but it still amazes me after all these years, after 12 years as a banker, almost 4 years with Hexclad, that so much of what goes on is just wrapped around financial instruments and the finance industry and private equity firms. I mean, talk about the biggest grift on the planet. The biggest grift. I mean, one PE firm trades this multi-billion-dollar company to the next PE firm, to the next PE firm. And these guys are all just making their carry and their management fee. It's a big Ponzi scheme.
It's hard to add to that. I agree. Like I hate it. I hate the whole space. I've hated it for years. I feel like the whole industry doesn't add a ton of value to the world, but that's such a deep topic. And it angers me.
I mean, that was what crypto was, right? Like the financialization of everything. It's like,
yes.
Hey, no, guys, we can financialize money now. It's like everything can be tokenized and broken out and traded on.
Like it was a good
Well, you know
thing.
what? The whole point of the podcast is we talk about operating. And here's the reality. If you can operate a business, you should operate. And you should invest money in your own ability to operate, because you're going to generate the best returns that way.
Yeah.
First and foremost, the world doesn't have enough operators, and investing passively is like you're betting on somebody else's ability to operate. Bet on your own ability to operate. That would be my advice first and foremost. Create your own thing, bet on yourself. Like we did the math from my initial investment in Simple Modern to what we think the market cap is right now. And it was something like a 300 and something % compounded annual return on my initial investment. I think it ends up being like 3,000x or something, and it was like, well, you're never going to ever be able to do anything in that realm over an 8-year stretch, doing anything other than operating. And so if you can operate, you should operate first and foremost.
Dude, that is a great summary. You are your best lever. Hell yes.
Yes. Here. That's a great way to finish it up. Okay, that is a wrap on episode 13 of the Operators Pod. Again, I want to say thank you to everybody listening. You could do us a small favor. We'd love it if you're watching this on YouTube, please hit the subscribe button. If you're listening to this on Spotify or Apple Podcasts, please rate and review and share this thing. And finally, a huge thanks to our sponsors, Northbeam, SendLane, and Fulfill. So that's it for episode 13.